Hey everybody, Marty Missouri here. It's After Hours on Tuesday, the 21st of November, 2023, with your midweek market snapshot. Clients, you'll get this in a link to an email in the morning. So I want to do what I've been doing lately, and that's open with a narrative and kind of tell you about the world as we presently see it, and then get into the technicals the last few minutes. So today I wanted to start with the message that I sent out in our written blog this morning that I title a hugely important quote. Longtime clients know that we do quite the in-depth year-end message, and that's something that I start getting on several weeks before. And looking at this year's schedule, I'm deciding I needed to start formulating what I want to express sooner than later. And as I say here, given the present market dynamics, we think it appropriate this year to focus a good bit of it on risk. And then, like I said here, while organizing my thoughts and looking through my library of related content / literature, I came across a quote that our current assessment has me thinking I need to share it right now. So I began my career in 1984, so I had the good fortune, and I mean that sincerely, of living through the 1987 crash, a recession and some turbulence in 1990, the bond bear market of 1994, the massive currency crises / collapse of the world's largest hedge fund in 1998, the tech bubble all through that period, and so on. And so what I say here is I must say that having lived intimately with and managed through the tech bubble, while unpopularly among a handful of clients, it wasn't everybody, a couple in particular I remember just weren't really happy. We had what I thought were phenomenal results in 1999, but if we were all tech, we would have been up at some crazy number, right? So while we were unpopularly reducing our tech exposure in 1999 during that final massive run-up. Due to that, I deeply sympathize with the following from Howard Marks. In the tech bubble, buyers didn't worry about whether a stock was priced too high because they were sure someone else would be willing to pay them more for it. That's the infamous greater fool theory. Well, it works until it doesn't. Valuation, and we've gone through valuations here recently, comes into play eventually, and those who are holding the bag when it does unfortunately have to face the music. The positive behind stocks can be genuine and still produce losses if you overpay for them. Those positives and the massive profits that seemingly everyone is enjoying, and we're going to talk about Nvidia in a minute, can eventually cause those who have resisted participating to capitulate and buy. A top in a stock, group, or market occurs when the last holdout, who will become a buyer, does so. The timing is often unrelated to fundamental developments. Prices are too high is far from synonymous with the next move will be downward. Things can be overpriced and stay that way for a very long time. I've experienced that more than once. Or become far more so overpriced. Eventually, though, valuation matters. Joel Greenblatt, if you don't know who he is, look him up. Phenomenal investor. He says, read that bullet point again. So I go on to say that, to be clear, we are not predicting, and I'm talking about during the months to come, because that's where I think the risk is, the kind of market meltdown experienced when the tech bubble imploded or during the 2008 financial crisis. In fact, we're not making any prediction whatsoever. What we are doing, from a very top-down, macro, and fundamental vantage point, is, folks, we are assessing the present risk-reward setup, and clearly, to us, this is not a time to be backing up the truck and chasing the cap-weighted S&P 500 like we think people are doing right now, or chasing a stock like Nvidia. I do mean this sincerely. Having done this for as long as I have, I've learned not to really make predictions. That's not what we're in the business of doing. What we're in the business of doing is assessing overall macro risk across each asset class, across each region in the world, and identifying where the opportunities are to exploit, as well as where are the risks to avoid or to hedge against. Basically, the message is simply, yes, the S&P is like up 18% this year, but the S&P equal weight is up low single digits. The Dow is up low single digits. Anything that's broad-based and not hugely concentrated, right? The Dow's not broad-based in terms of number of stocks. It's 30, but it captures a few industries. The S&P 500 equal weight is perfect because it basically captures the entire market, but it gives each stock equal weighting. If you take out the Magnificent Seven, as they're called, the S&P has gone virtually nowhere so far this year. And remember, from peak to trough in last year's bear market that we think we're still in, it was down 27%, and the NASDAQ was down well over 30%. And bonds suffered like their worst year since the 1800s. In fact, it's been the worst 3 years in 100 years for bonds. So tough spot for folks who typically default to like the 60-40 portfolio, 60% stocks, 40% bonds. This has been a not fun experience for them. But if they just kept their eyes closed and didn't do anything, they've made some back this year because those stocks are probably in like the S&P cap-weighted index and concentrated in the Mag 7. But we just have to explore and address where we are in the cycle and what does history suggest about a market that's as concentrated in a few select stocks as this one happens to be. So again, let me just reiterate. Don't know what's going to happen tomorrow or even a few months from now. We just know what the risk setup is currently, and we simply cannot ignore it, and we're afraid that lots of people, if not most people out there, are in fact ignoring it. So the oft referenced by me, Peter Bookvar, in a note this morning, I'll just probably paraphrase for you here. He's going to talk a bit about the general setup that he's seeing in the economy, and then he's going to talk about the Magnificent Seven stocks. He has a different name for them, as you'll see in a second. So for the week ended 11/8, the amount of commercial and industrial loans, and by the way, this is one of our 47 inputs to our PWA index, outstanding, seasonally adjusted, had its biggest one-week drop since the Silicon Valley Bank / regional bank crisis in March, the smallest amount since September 2022. On the consumer credit side, here were some key points from yesterday's Credit Access Survey on consumers from the New York Fed. The title, Consumers Expect Further Decline in Credit Applications and a Rise in Rejection Rates. Most credit application rates weakened except for applications for credit card limit increases, which rose. Rejection rates on credit applications rose overall, but declined for credit card limit extension applications. So they're allowing some extensions there. Rejection rates also declined for new mortgage applications, likely reflecting higher credit worthiness among the smaller group of consumers who actually applied for mortgages in 2023. Overall, reported rejection rates among applicants increased by 2.1% in 2023 over 2022, which was well above the 2019 level of 17.6%. Also of note, looking over 12 months, households anticipate that they will be less likely to apply for a new credit card, auto loan, mortgage, or mortgage refinance. Consumers also report significantly higher average perceived likelihoods of a future credit application being rejected, conditional on applying over the next 12 months. Indeed, this is not comforting. There was a slight increase in the subjective financial fragility of U.S. households, with the average reported probability of being able to come up with $2,000 if an unexpected need arose within the next month falling to its lowest level since 2013. Of particular note with rejection rates, the average rejection rate on auto loans increased by 5.8% to 11% in 2023, the highest since the start of our series in 2013. Bottom line, consumer and industrial loan data and credit tightening continues, and the demand for loans continues to shrink because of its high cost. He sticks to his death by 1,000 cuts economic situation where every day somebody's getting hurt by either a loan that is coming due, and of course having to refinance it at a higher interest rate, or a loan that is not getting taken out because of the expensive cost of capital. Most of these situations aren't making its way on the front page of the Wall Street Journal, but it doesn't mean that it's not happening. Also, this is the Magnificent Seven, for those hiding out and crowding into, he calls them the cult, 6 because it's losing Tesla, and I refer to them as cult stocks rather than using the magnificent term that others do, even though they have been magnificent stocks, and they certainly have of late. All those households and businesses impacted negatively by the current level of interest rates happen to be customers of these 6 stocks. These 6 companies do not drink different economic air, and I think he meant breathe, different economic air from the rest of us. As for those who are calling for a no landing or maybe a soft one, they are freezing the economic moment. They're just looking at the soft landing as a moment in time, and they're not interpreting it that way like they should be, and not following the trajectory of how things are unfolding, or they're not connecting the dots. And the trajectory of how things are unfolding, folks, that really explains our position right here and why we're hedging the downside risk in portfolios. And I'm showing you this each week on our macro update or our economic update, is just the trajectory of the data is pointing to or moving in the direction that just isn't good over the next several months. Now, you could argue that it's soft right now. Well, hard landings, if that's what we're going to get, of course they always begin with soft landings, save for, when we have a global pandemic and everybody gets locked up, right? Other than that, this looks much more typical to me, obviously, than the COVID situation. And because I've basically seen and managed through this scenario many times over my 39 years, I'm still not saying anything is inevitable here. It's just connecting the dots and looking at the trajectory and saying, folks, let's see this for what it is. It is not a time from these levels, from this stage in the cycle, to expect that the next new raging bull market is going to begin. I'm a little bit amazed, if not perplexed, by the pros who are suggesting it is. I do understand their narrative, and I could articulate it, and I could adopt it in a debate and become very convincing. It's just that it is worth considering and exploring and testing, but it should not be considered the highest probability outcome on a go-forward basis. It's one potential outcome, and it's a rosy one, and it would be great, but I just can't tell you from any angle that it's the highest probability outcome right here. Therefore, prudence is literally mandatory as far as we're concerned. Okay, so with the tech bubble in mind, I'm thinking a lot about Cisco lately because I've been thinking a lot about Nvidia lately, right? So I recall vividly in the tech bubble, ramp up and everything that went with it into the big decline, that companies like Cisco Systems were viewed essentially as safe havens amid a potential storm coming. And it would make some sense because Cisco is essentially the internet infrastructure. And while we did not believe for a minute in the dot-com craze and did not play in that, we played more traditional tech stocks and had a phenomenal run back then. We did believe that Cisco was going to make it. You knew that there were some real key serious players that were going to have good cash flow and survive perhaps a dot-com bust. And you could also argue that if we do have a recession or we do have a slowdown, the one thing companies are going to spend on is technology because that makes them more efficient, more profitable, and so on and so forth. Absolutely the case. But we had a problem. For one, we had huge concentration. So this is March 15th of 1999 through March 9th, 2000. And the blue line here in the second panel is the S&P 500 cap-weighted index. It moves with the bigger positions in it. And the S&P 500, same stocks, equal weighted. You can see during that year, up 7 versus minus 2.7. So massively bad breadth, right? We've been talking a lot about that for the last few weeks, if not months, right? And here's good old Cisco Systems. So here's the stock market rolling over pretty noticeably as we get into 2000, right? And that's the cap weighted, and the equal weight is really rolling over, right? And look at this. Cisco Systems is holding up. Cisco Systems looks like a safe port in this storm, right? So in the interest of time, let me just jump all the way out to the very bottom, which is March 9th, that's why I put that up there, 2003, and see essentially what happened here. Again, despite this period in here where stocks were rolling over pretty hard and Cisco continued to go, you can see that here in the first quarter, you might have come in thinking bearish. I think we were at the time, and it looked like you were right, and then stocks just ramped right back up right there with Cisco and so on, and then you see actually Cisco beginning to roll over here, but they're both kind of holding up until the fall of 2000, right? And now I can just hear it, because I had people who would argue with my concerns over breadth would say, the blue doesn't have to come down. The orange can come up and meet the blue, meaning the rally can broaden out. And it's very interesting, this chart, because the rally actually stocks did come back before rolling over harder. So there was a period there for, the better part of a year where the equal weight index actually held up while the cap weighted index was really rolling over with tech, right? And then finally, you can see we just kind of got this washout. Shows 36% from where I started back here versus 15% for the equal weight. From this peak to trough, this was just under 50%, and this was about 20%. So it wasn't horrible in the equal weight. 20% is a lot, but it was horrible for the cap weighted because of the tech. The NASDAQ index, folks, went down 80% during that time, and it's the NASDAQ that I keep kind of pointing to. And talking about that horrible breadth in the NASDAQ comp. And again, thinking about Cisco, I'm thinking about Nvidia today, because Nvidia really is the top dog with regards to AI infrastructure. Now, I will tell you that Microsoft is working on its own chip, Google's working on its own chip, and AMD is working on a chip. Nvidia is actually upgrading and working on their next generation, but it has some serious competition, and I'm not sure. I really don't know how wide its moat is, but it sure looks like a lot of people or a lot of companies are rising up to challenge them because of the utterly huge costs of this technology. So we shall see. But again, the view is that stocks like Nvidia are going to hold up because they are going to power the AI engine, which is as big as the internet, presumably going forward. So taking a look at Nvidia with the same thinking in mind. So here is November of 2022 up to, about a month and a week ago. So as you can see here, it's a similar looking chart than what I just showed you. This is Nvidia, but I was talking about Cisco before. Folks, this is the S&P cap weighted index, and this is the equal weight index. Just really, really, really bad breadth. It's eerie. And that's why I used that word recently. It's amazing, the eerie similarities of the two. And that's right up to how people are treating it and how people are thinking about it. And now when we go forward just to the current, this looks like that massive top that we had right there. Remember, it was suddenly the S&P shot higher along with the shoot higher in Cisco happening here as well. And again, it may be a totally different outcome. We're open to that possibility. But we have to look at what our economic model is telling us. And it was flashing red back then when we back tested it. It's flashing red now. And folks, clients in particular, I promise you, we are looking at this subjectively. We aren't bearish because we want to be. Most of you who've known me for the last 20 plus years know that I can be a very passionate bull on markets when conditions are set up that way. So we just have to maintain that patience and either wait for the storm to hit and take full advantage of it, or the storm clouds and the conditions that have us concerned abate and our earnings rise to meet where valuations are right now. The inflation cools off. The Fed potentially cools off. I talked about last time how it's just not a likely scenario that the Fed would cool off unless we have something quite dire feeling in markets and in the economy. But, again, that's that soft landing narrative. Who knows? It's possible. I'm not here to say I know what's going to actually happen over the next year. All we can say is this is a setup and we can't ignore it and we have to accommodate for it in portfolios. Okay, so folks, I think I've done plenty for just the narrative. Those of you who don't enjoy the technical analysis, thank you as always for watching and listening. And at the end of the week or over the weekend, we'll do it again and we'll talk about the economy. Okay, so the S&P 500 hourly chart just happens to be the one I have up here. And folks, remember I pointed to this rising wedge here on Friday. I said this is a very bearish look. Well, we broke out of it, but we broke out sideways, and then we've ramped up here, in these last few hours of trading. But what we really still have, though, what looks very wedgy to me, right? And here you have a marginal new high, right, from here to here, just this line right there. And even from there, we have a bearish divergence. So just technically speaking, on the very short-term hourly chart, this market looks very different than the one we were looking at here 3 weeks ago or so. On the daily, trying to get above that 4,600. This still is not the all-time high from last year, but it's getting closer, right? And it's not a horrible looking setup. I don't have massive bearish divergences like I do on the hourly. So the daily looks a little more encouraging. We do have a pretty fat little gap right here that I'm guessing, obviously I'm guessing will get filled. And we are overbought right here on the RSI. So you can see the circles, and you can see the last times we've been overbought, right? Here we just had, we had a little bit of a dip. Here we had a significant dip, right? We were overbought here, boom, boom. So we really haven't been overbought, over the last year without seeing somewhat of a sell-off in the market. Again, I do like the seasonality here for the bulls, but right now the technicals are a little discouraging for the bulls in my view. In terms of the NASDAQ 100 ETF that we track, just a massive move right here. There is a pretty big gap right here. If we did gap lower tomorrow, we're going to have what is called an island reversal pattern, and we pointed to these a few times in the past. These have high history of success, meaning if we gap down, I would expect at a minimum to come back and test this downtrend line, and ultimately I think it gets pierced in a recession scenario. But that's a pretty good dip from these levels here, and it probably would come swiftly. And it would begin tomorrow if in the cash session, when everybody thinks through and processes Nvidia's results today, that would probably be the catalyst. Looks to me in the futures market that the world is getting a little more comfortable with the results today. So we'll see. So a quick look at yields, because we've been looking at yields a lot lately. Remember in here, and I said, this could be kind of the makings of a bear flag. It gets kind of squirrely up in here. Tomorrow morning, I think the jobless claims number is a big deal. And if it's weak, yields are going to drop right here and bond prices are going to go up. And stocks will probably like it, quite frankly, if it's weak, because I still think we're in that bad news is good news phase of the cycle. Not how this thing ultimately plays out, but it's where we are right now. So we'll see. Jobless claims, I think tomorrow could be a real needle mover for the market. And folks, the dollar has been very, very friendly to the stock market. And remember, we were bearish right in here, just from a purely technical standpoint. Lots of folks were bullish. Remember this pattern I drew here with my pen, and that just played out instantly. We're just kind of flagging down here. I'm not super bearish the dollar for the remainder of this cycle, which I think we're getting toward the end. I don't know if I want to say super. I am fundamentally bearish on the dollar on a long-term trend basis going forward. And that gets me very, I don't want to use the word excited, but it gets me very optimistic about our prospects post whatever's left in this cycle in a weaker dollar environment. It's macro-rich in terms of opportunities going forward, but this is not the time to be putting on those positions in size, in my view. So, folks, that was longer than I had hoped for, but I appreciate those of you who've stayed with me this long, and I'll talk to you again very soon. Take care. Bye-bye.